Thinking about buying another investment property but strapped for cash? Refinancing an existing property could unlock the capital you need, but in 2025's market, it's not always the right move. Today, I'll break down when it makes sense to refinance for a new purchase and when it might hurt you more than help, with examples from investors in Ontario. Hey, what's up guys? My name is Saul Yassin, a licensed mortgage agent in Ontario and a real estate investor for over 15 years. This channel, Mortgages by Saul, is built to help real estate investors scale smarter and avoid costly financing mistakes. Refinancing to buy another property is one of the most common strategies investors use, but it only works if you understand the math, the risks, and the lender landscape in today's market. Here's why investors consider refinancing. They want to unlock equity. So if your property has gone up in value, a refinancing lets you access up to 80% loan to value on the new appraisal. You leverage your gains. So instead of sitting on debt equity, you can use it as a down payment to acquire another income producing asset. This is how people scale faster. So this strategy allows you to grow your portfolio without waiting years to save another 20% down. For example, an investor buys a townhouse in Kitchener for $520,000 in 2022. It's now worth $700,000. They refinance up to $560,000, paid off the existing $390,000 mortgage, and use the extra $170,000 as a down payment on a triplex in Welland. So what are the pros and cons of this? Well, the pros are you get tax-free access to capital. That's the best part. Enables portfolio growth, and you get a potential to improve cash flow with better terms. Some of the things to worry about, the cons: you have a higher overall debt load, possible increase in monthly payments. You'll need to requalify under current and tougher stress test rules. There's the appraisal risk, so your property may not appraise as high as you hope. This is why you always want to run a full mortgage analysis before pulling the trigger. But does this work in 2025? I mean, rates are slowly coming down, but qualification is still tight. You'll need to pass the stress test, which is at 2% above the new contract rate, and have a good credit and income stability, show that the new rental property will support itself, or else your ratios could tank. Another example, so a couple in Mississauga refinanced their detached home, pulled $200,000 in equity, and tried to buy a $900,000 duplex in Barrie. They passed the stress test, but didn't have enough provable income to carry both properties. So they shifted to a joint venture model with a capital partner who could co-qualify, and the deal was saved. Here are the smartest ways to make this work. So a HELOCs, so great for access to funds without redoing your whole entire mortgage. It's useful for deposit money or renovations. A blended mortgage, some lenders let you blend your current rate with the new advance and no penalties apply. Equity takeout plus B lender purchase. So refinance with an A lender, then buy with a B lender who has easier qualifications. Another option is refi plus JV strategy. So you refinance and then you pair with a money partner to qualify for a bigger deal. Each option has its trade-offs, and the right one depends on your income, credit, property type, and of course your long-term goals. These videos are more for educational purposes, so definitely get legal advice and talk to your professional mortgage agent if you have one. And if you don't, and you're thinking about refinancing to buy another property in Ontario, let's run the numbers together. Book a strategy call with me using the link below, and I'll help you avoid the common traps while building your financing game plan. So thanks for watching Mortgages by Saul. Like, subscribe, and let me know in the comments where you're planning your next investment. And if you want to reach out to us, again, you can call or text in the description below, and all our details are there. So thanks again for watching, and we'll see you on the next one.